Long-term care is any type of ongoing care that is needed by persons of any age who are unable to safely care for themselves. Long-term care refers to assistance with the very basic everyday activities that most of us can do for ourselves. We call them ADLs, or activities of daily living. As a result of illness, injury, or advanced age, many people need assistance in order to eat, bathe, or dress. The need for long-term care may also result because a person has cognitive impairment. Some people need supervision or reminders to accomplish everyday activities, such as toileting, eating, bathing, dressing, and so forth. Long-term care may be provided at home by family members, friends, or other caregivers. It could also include care given at adult daycare centers, assisted living facilities, and nursing homes. However, the ability to care for the elderly at home is being eroded by social change, including smaller, more scattered families. The most common misconceptions about long-term care are that it won't happen to me, or my family will take care of me, or Medicare or Medicaid will pay for it. As noted earlier, many people believe they will never need long-term care, or that they will only need it at the end of their lives. But the surprising facts are that more than half of all Americans will require long-term care at some point in their lives. And although the highest percentage of people who need long-term care are 65 or older, the next highest percentage, 44%, are between the ages of 18 and 64. Statistics show that 52% of women and 33% of men will require some nursing home care after they retire. Why do more women than men require nursing home care? Well, women generally tend to live longer than men. But studies also show that 75% of all Americans will spend some time in a nursing home. Unfortunately, 75% of single people and 50% of couples spend their life savings within 1 year of entering a nursing home. The 1999 MetLife Juggling Act study found that 64% of caregivers are employed and must juggle their personal and professional responsibilities. In addition to lost wages and benefits, 40% of caregivers found their ability to advance in their careers was compromised because they had to forego job promotions, transfers, or opportunities to acquire new skills. In addition, because caregivers often have to expend significant amounts of money on food, housing, transportation, and medications for care recipients, they are unable to devote resources to their own leisure time or home improvements. Then there's the added burden of the impact on the caregiver's health. About 75% of caregivers in the MetLife study reported that their health had suffered due to the strain of caregiving responsibilities. Caregiving can also be a significant risk factor for some people in developing depression. This is brought on by stress and fatigue, as well as social isolation from family and friends. Another way to pay for some long-term care expense is through Medicare, a federal health insurance program for people who are age 65 and older and for disabled persons of any age. Medicare was designed to cover some of the costs of certain healthcare expenses in order to provide access to a basic level of health care. Medicare will not pay for a private room, private nurses, or personal convenience items. Most of the care provided today related to chronic long-term illnesses or conditions is considered personal or custodial care, and in some cases may be rehabilitative. Custodial care means that someone is there when you need them to handle activities of daily living, such as cooking, cleaning, bathing, and mobility. Medicare will generally not pay for this type of care. However, Medicare will cover some long-term expenses for a short period of time. In Orlando, Florida, the 2017 average annual cost of a private room in a nursing home was $106,580. Long-term care expenses have been increasing between 5 and 6% a year. At this rate of inflation, the cost of nursing home care could hypothetically be more than $127,000 in 10 years and about $192,000 in 20 years. The average stay in a nursing home is 2.5 years. Without even factoring in inflation, an average nursing home stay could take more than $266,000 out of your nest egg. And even if the care is provided at home, the cost is about $25,000 a year. And that doesn't include out-of-pocket expenses to the caregiver or lost wages and benefits. Often, before someone moves to nursing home care, they receive long-term care at home for 5 to 7 years. Now we'll explore how to pay for long-term care. There are 4 ways to pay for long-term care. You can self-insure or pay out of your personal assets. Though this type of payment is a huge burden for most people, about 1/3 of all long-term care expenses are paid out of pocket by individuals and their families. About half of all long-term care expenses are paid by state Medicaid programs. Medicare only provides for some skilled care in some limited situations. Skilled care refers to rehab, therapy, treatment, all under a doctor's care. Neither Medicare supplement insurance nor major medical coverage provided by most companies pays for long-term care. This leaves approximately 1/6 of the total cost to be covered by other government programs and private insurance. Self-insuring means setting aside or having enough money to pay privately for future long-term care services. This will often require a dedicated, aggressive, and immediate savings plan. The question is, can you predict when you will need long-term care? In 10 years, 20 years, or 30 years? Though you may not require nursing home care or other long-term care until you're in your 80s, it's important to keep in mind that according to a report by Americans for Long-Term Care Security, 40% of the people who receive long-term care are between the ages of 18 and 64. Also, when you're considering whether to self-insure or not, be sure to compare the amount you would have to save annually with what you would have to pay in annual premiums for long-term care insurance. Medicare will only pay when you need skilled nursing care or skilled rehabilitative care on a daily basis. After a minimum 3-day stay in a hospital, not including the day of release, if you require a high level of care as prescribed by a doctor, such as skilled nursing care or rehabilitative services, Medicare will pay all the costs for the first 20 days of your stay in a skilled Medicare-approved nursing facility. In 2017, you're responsible for $167.50 per day co-payment for days 21 to 100 in a skilled nursing facility. No custodial or intermediate nursing home care is reimbursed. After 100 days, Medicare will not pay anything for these services, and the entire cost must be paid out of pocket. Keep in mind that admission to a nursing home is not enough to qualify for Medicare payment, and long-term custodial nursing home care is not covered at all by Medicare. Medicare provides full payment for intermittent part-time skilled care from registered nurses, therapists, and home health aides from a Medicare-approved home health agency. To qualify for this, you must meet all of the following criteria. You must be under the care of a doctor, need care for a specific illness, be homebound, need skilled services, need services on a part-time or occasional basis, or receive care from an agency that is Medicare approved. If you require skilled services, including nursing, physical therapy, or speech therapy, you may also receive occupational therapy, social work services, and home health aid services prescribed by a doctor. Prior hospitalization is not required to receive home health services under Medicare. Another way to pay for long-term care is through Medicaid, a joint federal and state program that pays for medical care for individuals who cannot afford to pay for their own medical care. To qualify for Medicaid, you must have limited income and few assets. Medicaid pays for a majority of our nation's nursing home costs. Unlike Medicare, Medicaid will pay for both skilled and custodial care, but in most cases is limited to care in a nursing home. Many people think a solution to qualifying for Medicaid is to give away their assets. The Omnibus Budget Reconciliation Act of 1993 changed the transfer of asset guidelines to qualify for Medicaid's nursing home benefit dramatically. Keep in mind that federal law requires every state to recover what was spent for the care for the first spouse at the death of the second spouse. State rules and practices for estate recovery vary significantly, and some states are stricter than others. Florida poverty guidelines for Medicaid eligibility require that a single individual's income must be no more than $2,250 a month and that an individual have no more than $2,000 in non-exempt assets. If both spouses need long-term care, the combined limitation is $3,000. If the spouse does not need long-term care, current Florida Medicaid nursing home eligibility guidelines limit the maximum amount of assets at $123,600. Before Medicaid applicants can qualify for Medicaid, they must spend down their assets, such as cash, stock, and other cash value items until only $2,000 remain. If there is an at-home spouse, any assets above the state-determined limit would have to be spent down as well. This does not include the house, one car, burial trust, clothing, furnishings, and personal items. Another disadvantage of relying on Medicaid is that you will be very limited in your choice of nursing homes. There are only a limited number of Medicaid beds available in a nursing home, provided they take Medicaid at all. In addition, Medicaid will not pay for a private room, private nurses, or for personal convenience items. Florida participates in the Long-Term Care Insurance Partnership Program, which is authorized by federal legislation. It is unique to long-term care insurance and provides additional asset protection for long-term care policyholders seeking access to Medicaid benefits. Because you live in a state that participates in the partnership program, you may be able to qualify for Medicaid in Florida while retaining more financial assets than would otherwise be allowed under Florida's Medicaid eligibility requirements. The asset protection is equal to the original benefit pool of your long-term care policy. To qualify for this additional asset protection, you must own a federal tax-qualified long-term care insurance policy and satisfy one of several age-based inflation protection requirements on the date of application. Partnership long-term care policies protect assets by matching dollar for dollar what policy holders pay into their policies. For example, if you bought a partnership policy with a maximum benefit payout of $155,000, then you are able to protect $155,000 of your assets. For married couples, each spouse needs to purchase their own policy. Once the $155,000 worth of long-term care coverage is used, you may apply for Medicaid with $155,000 worth of assets exempted. Depending on the type of policy, long-term care insurance can provide long-term care in many settings, including your own home, adult daycare facilities, assisted living facilities, and skilled nursing home care. All policies contain provisions that determine if and when benefits are payable. These are defined as benefit triggers. Generally, there are 3 ways to access a long-term care policy, and each of these should be separate, standalone triggers. Functional disability. Access to benefits is most commonly based on the inability of the insured to perform 2 or more activities of daily living. Activities of daily living are typically bathing, dressing, toileting, eating, transferring, and continence. Research has shown that bathing is often the first ADL that a person is unable to perform. Carefully read the ADL definitions for each policy, as there are no industry standards. We'll talk more about ADLs a little later. Cognitive impairment. Alzheimer's and other senile dementias are among the leading causes of nursing home admissions today. It is important for a policy to include these mental incapacities and that they are standalone triggers, not linked to any activities of daily living. And then medical necessity. Benefits will be paid if a physician certifies that as a result of an illness, injury, or chronic condition, the insured requires medically necessary care and assistance. Since 1997, this trigger is found only in some non-tax qualified long-term care policies. Non-tax qualified long-term care policies are not available in every state. ADLs are used to assess disability and to determine if the insured is eligible for benefits. It's important to know how reduced physical functioning is measured in a long-term care policy. Bathing, your ability to wash yourself in the tub, shower, or by sponge bath. Dressing, your ability to put on or take off your clothes. You may need help fastening and unfastening buttons or zippers. Toileting, safely getting to and from the toilet and performing basic personal hygiene. Transferring, moving in and out of bed, chair, or wheelchair. Eating, your ability to feed yourself. You may need help grasping utensils, getting food to your mouth, and cleaning your face and hands after a meal. Continence, your ability to voluntarily control bladder or bowel functions or care for incontinence if it occurs. Some people can perform their everyday activities without help, but they may need care because they have problems with their memory or orientation. When should you consider purchasing coverage? Typically, once you reach age 50 is when you start looking into purchasing long-term care insurance, especially if you have a family history of certain diseases and conditions such as Alzheimer's, stroke, severe arthritis, or other debilitating conditions that could put you in a higher risk category or increase the likelihood that you would need to spend time in a nursing home or a long-term care facility. Keep in mind that premiums increase as you get older, and the odds that you will need long-term care insurance also increase as you get older, which means you could develop a condition that would preclude you from being eligible for long-term care coverage. Assuming you qualify for coverage, each year you delay purchasing long-term care insurance after the age of 60, premiums will generally increase a minimum of 5 to 8% annually. These are the key factors to consider when purchasing long-term care insurance. The elimination period is the number of days you must receive care before benefits are payable. It is essentially a deductible in the form of an elimination period of 30, 90, or 180 days during which you must pay the cost out of your own pocket. Generally, the longer the elimination period, the lower the premium. The average nursing home stay is 2.5 years. You can insure for the average stay, or you can insure for a longer stay. This is the benefit period, which can be anywhere from 2 years to an unlimited number of years. The maximum daily benefit ranges from between $50 to $200 a day. The higher the amount, the higher the premiums for the policy. Check how the daily benefit will be calculated. Is it each day's actual charges, or the daily average calculated each month? The latter is better for home care because caretakers may visit many times one day, but very little the next day. The benefit pool is the sum of money available to pay qualified long-term care expenses. It is calculated by multiplying the months in the benefit period by the monthly benefit maximum selected. Shared plans allow individual benefit pools to be combined and shared by a couple. Inflation protection is a key factor to consider involving annual benefit increases compounding at either 3 or 5% each year. This may be the best choice if you're under age 65 because of escalating costs of health care. The second option is a simple interest increase in which there's a 5% benefit increase each year calculated at simple interest. This choice might be best if you're aged 65 to 70. And finally, there's the option to buy more coverage at periodic intervals without reapplying and without evidence of insurability. Also note that inflation protection options can make premium costs as much as 50% more. Waiver of premium is a standard provision of all policies, but the event that triggers the waiver varies from policy to policy. In general, this provision waives or stops the payment of premium while benefits from the policy are being received. In some policies, only nursing home care waives the premium, which would continue with other types of care such as home health, nursing home, assisted living, and adult daycare. Guaranteed renewability. This means the insurance company cannot cancel the policy if the premiums are paid on time, even if the health condition of the insured person has deteriorated. However, you should note that the premiums paid each year can and probably will go up in price with any company. One of the important things to consider in a policy is a guarantee that the policy cannot be canceled, non-renewed, or otherwise terminated because you get older or suffer deterioration in physical or mental health. Let's review what we've learned about long-term care. Statistics have shown that 70% of Americans will need some form of long-term care during their lifetime. Approximately 40% will need long-term care before the age of 65, and 70% will need it after the age of 65. In 2017, the average annual cost in Florida of a semi-private room in a skilled nursing facility was $94,900 or $260 a day. The average annual cost in Florida of an assisted living facility was $37,200 or $102 a day. The good news is that 74% of long-term care policyholders receiving benefits remain in their homes, with 14% receiving care in assisted living facilities and the balance receiving skilled nursing care. Receiving long-term care in your home is the most desirable and least costly method of managing long-term care. Is self-insuring still an option? For some it is. If you're Warren Buffett or Bill Gates, it might be. If you have significant cash reserves, it might make economic sense. But who will pay for your long-term care if you can't? You, your family, Medicaid, or an insurance company? Do you want or need to preserve your financial assets for your spouse or family? And there's the common concern of paying for something you may never use. If continuing to self-insure makes economic sense for you, let's consider a more efficient way of doing it. If self-insurance still makes economic sense, a single premium long-term care plan might be a better solution. It utilizes a universal life insurance policy with long-term care benefits issued by an insurance company. It provides monthly long-term care benefits you can use to reimburse qualified long-term care costs, helping to leverage assets you've set aside for retirement income. And these reimbursements are intended to be income tax-free. Guarantees are backed by the claims-paying ability of the issuing insurance company. Let's see how it works. Chances are much of your retirement income will be based upon the assets you've accumulated during your working years. There are investments for growth and income. This is usually the portion of your portfolio that provides much of your retirement income, like 401ks or IRAs. There are cash reserves set aside for emergencies, and there may be money you've set aside to self-insure against the potential need for long-term care. Cash reserves are highly liquid. You can access their value more easily than selling stocks, bonds, mutual funds, or your home. By simply moving some of your cash reserves into a single premium long-term care policy, you immediately leverage your assets. This may help increase protection for the rest of your portfolio and for your retirement income that's based on that portfolio. Now here's the part that often gets people to sit up straight and pay attention. In many cases, a single premium long-term care policy can provide you with up to 5 times your premium dollars to reimburse long-term care costs. That's what we mean by leveraging. Reimbursements for qualified long-term care costs are intended to be income tax-free. Benefits are paid up to the maximum monthly amount specified in your policy. Specified amount of death benefit is used to reimburse long-term care costs. You get up to 5 times the premium dollars. Optional riders can provide coverage for specified number of years after death benefit is depleted. The cost of riders are deducted from the policy's account value. If you don't use all of your specified death benefit for long-term care costs, any portion of the guaranteed death benefit not used for long-term care benefits will pass to beneficiaries income tax-free. Any money borrowed or withdrawn from the policy will reduce the death benefit. Now, suppose you decide for some reason that the single premium policy is no longer right for you. In this hypothetical example, you get your $100,000 premium back by notifying the insurance company in writing of a full surrender of your policy. These single premium long-term care policies provide a money-back guarantee through the return of premium rider on single premium and certain flexible premium universal life policies. Your premium payment can be returned to you minus any loans, withdrawals, or benefits paid, and is subject to the terms of the return of premium rider. Long-term care protection, a death benefit, and a money-back guarantee to help you maintain control of the assets in your retirement portfolio. The most common reasons for purchasing long-term care coverage include the desire to remove the financial burden and emotional stress from family members, the desire to maintain one's own independence and quality of life, the need to maintain flexibility and control of care options, the need to protect retirement savings from depletion by long-term care expenses, and the desire to preserve your estate for your spouse or family members. Which of these reasons apply to you? Let's revisit our self-insured couple, ages 60 and 62. In this example, the couple would need to allocate over $283,000 within their investment portfolio to cover 2.4 years of nursing home care, or begin saving from $530 to over $1,500 per month to prepare for this long-term care expense. Is this a realistic strategy for most people? Only if you have the money or know when you'll need it. By shifting the risk to an insurance company in the same manner accomplished with your homeowners, major medical, and auto insurance, the cost of covering your long-term care risk can be affordable and immediate. We've discussed the average cost of care in Florida. You can learn more by visiting genworth.com to access the 2017 Cost of Care Survey for costs specific to your community. Request a long-term care risk assessment by visiting www.financialfactfinder.net. You'll need accurate estimates of your income sources and financial assets. A customized financial solution summary will be prepared for your review, including a telephone consultation to answer all of your questions. Start the discussion with family members about their thoughts about your long-term care options and the role they are prepared to play. Revise your retirement plan to include the cost of long-term care and determine whether continuing to self-insure is a realistic option. Your final step is taking action to mitigate your long-term care risk exposure. Complete the questionnaire by visiting financialfactfinder.net. You'll be asked to provide estimates of your income sources such as Social Security income, pension income, and investment income. You will need to provide estimates of financial assets and liabilities such as retirement accounts, savings, checking, brokerage accounts, and estimated value of your real estate. Estimates of short and long-term debt such as mortgages will also be necessary. This information will be used to prepare a personal balance sheet and projected retirement income statement. Preparation of your personal financial statements will help determine what kind of financial solution options will be recommended. Your financial solution summary will be completed and emailed to you within 72 hours of your completion of the Financial Fact Finder. Your long-term care risk exposure is like a threatening hurricane that is over the horizon. You are watching it approach. It's real. It's going to make landfall. There's a 70% chance you'll be affected by it. Will you qualify for coverage? Can you afford it? Evacuation is not an option. Will you, should you do nothing and hope you won't need long-term care insurance? You have taken an important step toward learning the fundamental issues and concepts driving the need for long-term care insurance coverage. Your next steps are completing the Financial Fact Finder, reviewing your report, and completing our telephone consultation.